With good intentions, without being aware, is it possible you can make a decision in retirement and all of a sudden create an enormous tax surprise where you go from not having a lot of your Social Security being taxed to a lot of it being taxed all in 1 year and owing a lot of money on your taxes? I want you to avoid this surprise. I'm going to tell you the 4 things that often cause this to happen. I got that and more coming up. At the time I'm recording this, we are wrapping up tax season for 2026 for your 2025 taxes. And by far, the biggest tax surprise that we hear from our from clients that we serve that only use us for tax preparation, don't do financial planning, by far the biggest tax surprise is taxation of Social Security. I would say just honorable mention, number 2, the second biggest tax surprise is side hustle that becomes main hustle. When you've got employment income, you don't understand how it's taxed and you're not withholding taxes or paying estimates, that's another big fiasco. And I don't like tax surprises, period, right? Tax planning is one of the 6 areas of your financial life. And there's 2 goals of tax planning. 1, to identify the opportunities for you to pay the least amount of tax over your lifetime, if not multiple lifetimes. That's 1, and that's the fun stuff, right? And then number 2 is avoid tax surprises. That's the second goal of tax planning. Therefore, I want you to avoid this main tax surprise, which is taxation of Social Security. Now, the root of this is your Social Security, whether it's taxable or not, depends on a formula. And it's the same formula. It's the same formula every year. And sadly, it's the same formula for decades. They've never changed it. There's never been a cost of living adjustment to it. However, this formula is based on your income that year, and when you lose sight of that, or when it slips your mind, or when you don't quite understand it, you can make a decision with all the right intentions and assume that, well, each year is going to be the same for your Social Security on your taxes and be walloped with an enormous tax surprise. How's that formula work? Well, for single individuals, you add up all of your other income, plus half of your Social Security. And if that formula is greater than $25,000, yeah, that's a small number, greater than $25,000, some of your Social Security starts becoming taxable on your tax return. The higher the number is, the higher that formula is, more and more of your Social Security starts becoming taxable until the maximum amount of your Social Security is taxable. And thankfully, it's only 85 cents of every dollar. So you're not currently, under current laws, you won't pay tax on all of your Social Security, just most of it, okay? The higher and higher that formula goes. That's for single individuals. Married filing jointly, same sort of formula, okay? All of your other income plus half of your Social Security, but you'd think for married filing jointly, well, that would just double the number. If it was 25, then it's gonna be 50. No, guys, 32,000. 32,000. That's for married filing jointly. That means some of your Social Security starts becoming taxable. And then the higher that number goes, more and more of your Social Security becomes taxable up until that maximum of 85 cents of every dollar of Social Security becomes taxable. Because of how that formula works, here's what we see in the trenches. What we see is if you don't have a lot of IRA withdrawals, pensions, or other sources of income, plus half your Social Security, very little of your Social Security is taxable, or maybe none of it at all, and then you've got a huge standard deduction and you don't pay any tax. And then all of a sudden something changes and you go from very little of your Social Security being taxable or none of it being taxable to the majority, right? 85 cents of every dollar of Social Security, just like that, becomes taxable. And then instead of paying no tax, you now pay a lot of taxes, and it's a huge tax surprise. What are those things that cause that tax surprise? First, it's just more IRA withdrawal than a normal year. So withdrawing more dollars out of your IRA, so innocent. In fact, the reasons that cause it are even more innocent. It just had to deliver some awful news to some very sweet couple. And when we did their taxes this year, for several years of retirement, life has been the same, and their withdrawals from their IRA along with their pension just hasn't amounted to much, and therefore very little of their Social Security was taxable. Well, last year they bought a new car. And they didn't want to get a loan, and therefore they took a chunk out of their IRA. They never talked to a financial planner. They had an investment advisor that's helping them with their IRA. They didn't have a financial planner that would tell them, well, wait a second, how much of, let's take a look at your tax return. How much of your Social Security are you paying taxes on? Does it make sense to only draw a little bit out, get a loan, and then draw more out next year so that between the 2 years, it maximizes or optimizes, I should say, the amount of tax you pay on your Social Security? Instead, they went from very little of their Social Security being taxable to the maximum amount. And it caused them to owe about $4,000 on their taxes. Guys, that is a huge surprise. Yes, it's frustrating that you're paying more tax on income that normally you wouldn't pay tax on. But to make matters worse, now you've got to come up with the $4,000. Where's that going to come from? Likely more withdrawals from the IRA, which exacerbates the problem. The second biggest cause of this surprise is just the other side of that same coin, and that is turning on your required minimum distributions. If you're in a financial situation where maybe you've got some dollars in cash or maybe some dollars outside of a tax shelter and you're living on those and your Social Security and you're really not withdrawing anything from your IRA, then again, this formula for whether your Social Security is taxable is likely going to be very low. It's going to be very advantageous to you. And then all of a sudden you turn age 73, soon to be 75, but age 73 and you are required to take at least a minimum amount out of your IRA. And you might say, well, I don't really need this money, so I'll just kind of reinvest it back in my savings account or in this other account where I'm drawing dollars from, but not realizing that, $10,000 of required minimum distribution, for example, causes another $6,000 of your Social Security to be taxable. I'm just, ballparking there. And so just, unbeknownst to you, you've got an extra $16,000 of income that lands on your tax return, and that's going to create an enormous tax surprise. So required minimum distributions. How can you manage both of those? These are just two of the surprises. I've got two more, but IRA withdrawals and RMDs. Being mindful of the Roth throughout your career and early in retirement, doing Roth conversions so that as you need to draw money out of your retirement accounts, you have a choice. Should I draw from our pre-tax and therefore, the traditional IRA and influence this formula for Social Security taxation, or should I draw from the Roth? And same with the required minimum distribution. There is no RMD or required minimum distribution on the Roth IRA, and even if there was, it wouldn't impact this formula. So the way to help neutralize or minimize these first two surprises, advantage Roth IRA and be strategic about how you get money into the Roth throughout your career and early retirement. The third thing that can cause a surprise with Social Security taxes is an unexpected capital gain or even an expected capital gain. So capital gains can occur when an asset is sold outside of a tax shelter. And I know tax shelter, geeky word, geeky term, but that's, Roth IRA, 529 plan, HSA, those are all sheltered from tax. When you withdraw money, there might be tax depending on which of those tools I just talked about. But if you have an asset not in an IRA, not in a Roth IRA. So you've just got a brokerage account, an individual account, a joint account, something like that. Or maybe you own a rental property, something like that. And you sell an asset, it's going to land on your tax return as a capital gain if your basis or where you bought it for, what you bought it for, is less than what you sold it for. The difference between that is a capital gain, and that's going to land on your tax return. If you had an investment, maybe you inherited some dollars, or maybe you've had an investment that you've just been let sit there, and then you sold that investment, that capital gain is going to land on your tax return. And guys, that's going to influence this formula. Even if you say, well, wait a second, capital gains rates, I'm in the 12% tax bracket, and so therefore my capital gains rate is going to be 0. Okay, great. That's fantastic, and you're going to want to optimize that. However, it still counts towards that formula for Social Security taxation. Even though that capital gain isn't taxable to you, it lands on your tax return, and it's going to influence this formula. Making matters worse or exacerbating the surprise is when there's an unexpected capital gain, where you own a mutual fund that's actively managed and you didn't sell anything, but the mutual fund manager within the fund, this is what they do. They will buy and sell securities inside the fund. You don't approve it. You don't get a vote. You can't even see what's happening. You're entrusting that manager to make great decisions, and they're going to buy and sell. And then at the end of the year, they're going to kick out a capital gain distribution. You don't even notice it when you're looking at your statement, and then you get your 1099 from that non-tax sheltered account. When you do your taxes, there's a capital gain distribution, lands on your tax return. All of a sudden that influences this formula. More of your Social Security becomes taxable. And then the final surprise, the thing that catches people by surprise and causes more of their Social Security to be taxable, this is a good thing and a bad thing, is interest on a savings account. We went a long time, basically from 2008 to 2021 or 2022 where you weren't getting any money on your savings account. And hopefully you didn't have it sitting in a savings account as in a high yield money market, but you were still getting next to nothing, 2% maybe. And it would barely make a dent on your tax return, even if you had a lot of money saved up in there. Interest rates have been coming down, but they were up 4.5%, 5%. Now they're down 3.5%, 4%. Still, depending on if you've got a fully funded emergency fund, or again, we're talking about taxation on Social Security. So if you've got a lot of dollars that are just in the bank because you don't want to take a lot of risk and you want that financial security, having a higher interest rate, which is good. I want you to have a higher interest rate, but that interest lands on your tax return, and it's part of this formula. All of your other income plus half your Social Security, that interest income is part of all of that other income and can cause a big surprise on your taxes. The solution to those last two surprises is leveraging and utilizing your tax shelters. I know that's super geeky, but being tax advantage with your contribution. So funding your Roth, funding your IRA, funding your HSA, so that interest and those capital gains don't land on your tax return each year because they're sheltered from tax. So the big surprise of, oh my goodness, my Social Security is all of a sudden taxable and I owe a lot of taxes is typically caused by one of those four big tax surprises. So work with your certified financial planner throughout your career before you're on Social Security so that you have more choice, more flexibility, and so that you can reduce the amount of tax that you pay on your Social Security out there in retirement. If you're listening to this in retirement and you say, yeah, that happened to me, is it too late to make some changes? No, it's not. Work with your CFP. They've got to look at all 6 areas of your financial life, not just your tax planning, right? That certainly is in focus, but they've got to look at your present financial position, your investment planning, all areas of your financial life to come up with the great strategy so that you can improve this formula. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with Kate, wisemoney.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.